Super microcomputer SMCI has been one of the best performing stocks recently, with the stock up over 800% in the past year. If you zoom out just a little, I mean, this is the type of track record that you'd expect over a multi-decade perspective, yet over in just the last 5 years, SMCI stock is up over 5,000%. What's going on with super microcomputer stock? I'm going to talk about what do they do? This is my first time sort of providing an overview of the business. So I'm going to share my own personal learning process and what do I think about the stock right now after this monstrous run? Is this just the beginning of a huge, just where it goes up 5,000% and then it goes up another 5,000%? So that's what we want to explore in this video. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of hitting that thumbs up, hit that subscribe button. So understanding, what do they do? SMCI, I go to AI Ticker Chat. First month is free. This is, you see the link below. And so I want to get a summary of, understanding their financials, pulling from the 10K, the relevant financials. And it talks about how SMCI is a provider of accelerated compute platforms, focusing on high efficiency server and storage systems. So talking about total IT solutions, servers, storage systems for various markets, including data centers, cloud computing, artificial intelligence, 5G, and edge computing. So you're really talking about a key provider for server and storage systems. Now, this might seem a little bit surprising because a lot of people have seen the explosion in terms of demand from generative AI. And I do believe this AI revolution is real. And we're just in the super early days in terms of how this revolution will impact society. And you've seen that flow through to NVIDIA. But how does that, where NVIDIA is making the cutting edge GPUs that helps power these models? So where does Supermicro sort of fit in? The way to look at it is they're actually making these racks. So these server racks, and they're talking about making up to 4,000 per month capacity during the most recent quarter. And thinking about this business model, it's about taking all these, semiconductor chips. It's about setting up the systems that can store this data, sort of turbocharge it and also keep it protected and running smoothly. So that means, and you can see some of the terminology about how it's the free air, liquid cooling, and traditional air cooling technologies provide customers the optimized data center solution. So if you're looking to make these multi-billion-dollar data center investments like you've seen Mark Zuckerberg do with Meta, it's, you're saying, hey, how do we effectively manage this? So it's the rack that holds all this data, holds all this equipment that you're buying. So the chips themselves, they're making sort of the rack and the systems that put it all together. And a key aspect of this is the leading energy efficiency. So lower total cost of ownership. So what you're talking about is, hey, if you were to get all these systems in place, how do you make sure you're not overdoing it, let's say on your energy bills? Because, when you're running these servers, they're critical for the operations of a website or for an AI demand. And so recognizing that, hey, this needs to be constantly running. It's going to generate a lot of energy. How do you make sure your total cost of ownership is lower? So these are the types of things that they're addressing, also dealing with the security of it, also the underlying server software management. So this is very high level overview of what do they do. This is my first time looking into it, as I've already mentioned, looking at how they've done over the last few years. This is a chart that management has provided, suggesting that for several years, they've sort of moved in lockstep with their underlying competitors, the industry average versus Supermicro sort of in line. Yet in the most recent periods, last couple of years, their growth rate has really ticked up, where they've clearly been taking market share, growing much faster than the broader industry for their rack scale solutions. And they're talking about, and they show, look, we've been around for a long time. We've gone from subsystems to complete systems to the total systems, now the 5 S's, the software, service, switching, storage, and security. And it's all about taking these systems and making them efficient for their customers. As I already mentioned, the total cost of ownership. And they talk about this path to $25 billion. That's a mental note. Remember that $25 billion. We're going to talk about that in just a minute or two. And talking about how they're growing 5 times faster the industry average. So that is something I love to see. When I see a company that I'm interested in investing in, I like to see management say, hey, we're growing twice the industry, or we're growing, significantly 50% faster, 100%, 200%, much faster than the industry. It suggests you're doing something right. And so that's one of the things you're going to want to understand. What are they doing that is enabling them to win, so much faster and take market share from their competitors. Because at the end of the day, if you look at the rack space, the server space, you're not really talking about something where I believe any one company is unrivaled. You're sort of repackaging some of the critical hardware from your suppliers. And we'll talk about that dynamic in just a second. But looking at Supermicro's revenue, this is the reason why the stock has gone parabolic, is that this is the quarterly revenue chart. You can see for years they were close to, let's say, $500 million in quarterly revenue. And then in the most recent quarter, you're talking about over $3.5 billion. So that is a huge change just in terms of the trajectory for this business. And when you see this dramatic acceleration, as we've seen in the last few years, where the quarterly cadence of their sales has really been stepping up because of this AI revolution and the demand for these servers to power it, this is the reason why the stock is up so dramatically. And management is also expecting this growth to continue for at least this next year, talking about around $14-15 billion in sales. Keep in mind, this company previously was doing around $1 to $2 billion in sales if you just zoom out a few years. So this is a huge change. This is why the stock is up so significantly. Why are they winning market share? That's one of the things I want to understand. And so I ask AI Ticker Chat to go through the transcripts, sort of what is management calling out? What are they talking about the 10K for why they might be winning? And it comes down to being first to market with new technologies. They talk about how they're oftentimes one of the first to bring their customers the latest solutions before their competitors. They talk about having a dedicated engineering team. I sort of view that as table stakes. You need to have a dedicated engineering team in order to win in this space. And they're willing to be competitive on pricing and invest in initiatives to lower their cost. So being competitive on pricing, that is code for we will lower our gross margins. We will lower the profitability if that means we're going to win. And also they're talking about lowering our cost structure, it's talking about, scale, being able to grow this company at scale. But these are the key aspects, which is that they effectively are willing to move faster. They talk about their building block solutions, which allows them to integrate these new chips, faster, let's say, than their competitors. And this is what their customers want. Now, as I already mentioned, a large part of their business model is sort of repackaging in a way the key semiconductor chips from their customers. So I want to understand, what's that dynamic? Is it when someone's buying a server from Supermicro, how much are they paying for, let's say, NVIDIA's chips versus saying, hey, I really like the Supermicro envelope and make sure that the total cost of ownership is right. So quickly looking at, A, the supplier concentration, and B, the gross margins. We'll talk about both of those aspects in a second. That should help you start thinking about who sort of has the leverage in the industry, and looking at, who are the main suppliers, how much concentration risk is there, once again, pulling from the transcripts and the annual filing. And management calls out, or at least AI Ticker Chat indicates that management hasn't explicitly named their suppliers. However, they clearly do have working relationships with Intel, AMD, and NVIDIA. So I would suspect it's NVIDIA as well as AMD are their top, let's say, two suppliers. And this is potentially an issue because you look at their supplier concentration and roughly 50%, a little bit more, is in, let's say, their top three. In the top two, it's just 31% and 14%. So that does mean a lot of the power, let's say, is going to go to your supplier, because you're going to have to say, NVIDIA, I want the latest cutting edge chips. You're the one that provides it. And, how am I going to, what are the customers ultimately paying for? And when you see your gross margins are 15%, that means the bulk of your purchase, the bulk of your sale actually represents sort of selling the NVIDIA chips plus the markup that you have for putting it all in your system. And you can see their margins, and I talked about management has said that they're going to be investing in price, and that's something they're willing to do. You can see how during this period of rapid growth in the last few quarters, their margins have actually gone down from 18% to around 15%. This is a gross margin. So this is before their sales, this is before their research, their development, general admin expenses. So this is very, very thin gross margins. When you're talking about software gross margins, you're oftentimes talking about 70, 80, 90% gross margins. So it's important to recognize this dynamic. When you see 15% gross margins, that means the vast majority of what customers are paying for are not actually the Supermicro rack or the Supermicro server, they're really paying for the chips inside that Supermicro is paying their customers for. So I'd say the balance of power is with who has the most cutting edge chip, but they are benefiting from this AI revolution in terms of people, businesses. More and more applications are being built, more and more cutting edge models are going to be rolled out in the coming years. You're going to see dramatic usage in AI pretty much touching everything. And if you expect that, then you're going to need a lot of processing power for that. So you're going to see this is one of the boats that's going to rise in this situation with Supermicro rising, but it's really, partly driven by them selling chips. And it's the chips that are people that really the customers are paying for. So how should we think about the valuation of Supermicro? First of all, in full disclosure, this is not financial advice. Also, quick plug, just last week, a premium member of the Unrivaled Investing community shared on our exclusive Discord. This is a direct quote. And it's a new direct quote from a different customer at Unrivaled Investing saying, currently, the profit I have made thanks to called out ideas from Daniel can pay for 30 years of subscription, but the most valuable part has been the learning experience. This is something I'm definitely looking to personally cultivate, is a learning environment. We're all learning. And he continues going, I have been a very satisfied member since June 2022. Since then, I have never doubted to renew. So for compelling investment ideas, feel free to check out unrivaledinvesting.com. I also share my personal investment journey. I do expect to be raising prices later this year. So when I look at Supermicro, one of the key aspects I look at for any prospective investment is I want to make sure there's alignment with management, because it's one thing to say, hey, this stock's working out really well. It's another thing to say, hey, do I trust the people that I'm effectively putting this capital, with? Do I trust, am I partnered with them? Do they have an interest to perform for their own stake in the business? And when I see that there are several parties, several executives, directors, stockholders that in all own more than 43% of the company outstanding, and it's largely management, along with a few, interesting investors, it does get me interested. And so that says, okay, there's definitely some alignment here. So it passes that test. This is what I'm personally looking for with my own personal investment journey. If I don't see a company with dramatic alignment like that, I will prefer to, my sort of go-to is then, do I trust management to return free cash flow to shareholders? And do I have a really strong assessment that management will create value, and what's their track record been over time? So there's sort of two steps. Is one is, do you just have the economic incentive? Next is, do you have the chops? Do you have the experience that reflects that you'll create value for shareholders? That increases the odds, in my opinion, that you could have a satisfactory investment. So I like to see that aspect with Supermicro. Interesting to see the latest developments. I'm pulling up the news item, looking at the 8Ks at AI Ticker Chat. And, it's interesting. Management is clearly not dumb. They've seen a record rise in their stock price very fast, and they're saying, hey, how do we capitalize on this? And so they recently they issued $1.7 billion of 0% convertible senior notes. They also issued $1.7 billion in stock. 2 million issue using 2 million shares via Goldman Sachs. So, I'm seeing these developments where management is just issuing billions of dollars to sort of shore up their balance sheet. And it didn't strike me that they hadn't, an unreasonable balance sheet before. So this is management recognizing that Wall Street spirits, they're capitalizing on favorable Wall Street spirits, I think, here. When you see management say, yes, print, billions of dollars, shore up our balance sheets, put billions of dollars of cash on our balance sheet, that creates optionality. That's the beauty of cash, is that optionality of, if things, let's say if the AI revolution, there's a burp where, it doesn't go straight to heavens. It doesn't, the revolution isn't overnight. It takes, let's say, a few years. If there's a bump one quarter or there's a recession, hey, they're going to have the balance sheet to make lots of really interesting investments. So I overall very impressed to see these initiatives. That said, they are still focusing on this $25 billion plus in revenue. And it's important to think about that in context with their valuation. This is what their goal is, let's say in the next couple of years, to achieve. And, this year they're penciling out somewhere between 14, 15 billion. Now, based on, I already talked about gross margins of 15%, let's say, talking about operating margins historically, anywhere from low single digits, 1% to 10%. Let's say it's around 10% in the future. I mean, you could see this is a multi-year perspective. Once again, this is a low margin business because most of the value add actually is them sort of reselling these chips, but wrapping them up in their rack or their own envelope. And so thinking about, maybe a 10% margin on a future $25 billion of sales. So maybe around $2 billion in profits after taxes, all that jazz. So thinking about it, now it's currently around 60 billion plus valuation versus this future, maybe next year, they're doing that $2 billion. So you're trading around 30 times. If you think about where they're trading this year, possibly between 40 and 50 times, depending on where their margins shake out, what their underlying growth is. I already mentioned around, $14, $15 billion in sales this year. So just tremendous growth, tremendous acceleration. The question is, where do they go from here? And, it's just super tricky to think, to have a call on saying, hey, I think they're going to grow, let's say, consistently faster than 30% over the next 5 years. I think things are lumpy. I think, trees never grow straight to heaven, as I already alluded to. And so in this scenario, this high case scenario, you get this 110% growth this year, 12% margin, 30% growth in the years after. And a 25 times multiple 5 years from now only gets you around 70% upside. So that's not really that dramatic. Whereas if there's only 20% growth and 8% margin, so a little bit of a haircut from where they currently are, then, in a 15 times multiple, then you're talking about, losing over half of the value in Supermicro. So I personally look at this, and unless you have a call on, hey, I think this revolution, and there's a real AI revolution, is going to result in another year of, let's say, 100% growth in terms of their demand, in terms of their sales. It's possible, but not the framework I'm penciling out. And keep in mind, the framework I'm penciling out, in the high case, it's going well above the $25 billion that management has recently called out. So even in this scenario, you're not really talking about hundreds upon hundreds of percent upside to have tremendous execution. So I personally look at this, and it's difficult for me to really get my head around saying, hey, the valuation at this point is worth even, putting my toes in. But I could be wrong, and that's why it's a hypothetical valuation framework. Of course, stock price can go way higher, way lower. If you have a different take, I'd love to hear it. You might argue my valuation framework, the end multiple 5 years from now might be too conservative, but that's partly because, it's this assumption that it's almost like a capital expenditure, that indeed what it is for their end customers, and that, you could have boom bust cycles where there's just tremendous growth, and then all of a sudden there's a drop. And, if you have that dynamic, then I don't think the end multiple should be, multiples higher. It's not like the recurring revenue nature that you get with certain types of businesses. Now, I personally, you might say, Daniel, you're never calling out stuff that you actually do like. Well, that's not actually the case. You could check out Fairfax. I've done a couple of videos on Fairfax. That's one of my holdings. I prefer to keep my holdings, in terms of what I'm doing at unrivaledinvesting.com, but I do occasionally call out something that's particularly interesting. And so when there was a short report on Fairfax, I called that out just a few weeks ago. But I hope this video, talking about Supermicro SMCI has been helpful, just providing a context. What a run. Very impressive to see it. Like, in order to be able to sit through that, you have to be just incredibly patient investor to be able to sit, because it wasn't just straight up. There were periods where, revenue declined one quarter. So you'd have to have the patience to say, hey, and the ability to see through that quarterly decline and say, hey, I am such a believer in this AI revolution and the future demand and the alignment with management. Now they did check that box, that you'd say, hey, I'm just going to sit through it. Even if there's a couple of bad quarters, I think it's just going to do really well. So congrats to all the shareholders that have seen this 5,000% rally. It's incredible. And thanks so much for tuning into Unrivaled Investing.